Our countries in Sub-Saharan Africa have been locked out of international debt markets since 2022 owing to higher borrowing costs. Kenya made an attempt in 2023 but quickly cancelled because it simply couldn't afford it. However, it looks like the jinx may have been broken as Cote'd'Ivoire is set to end the drought of issuances as early as next week. Now, analysts say the drought of bond issuances showed the disproportionate impact that higher U.S. interest rates are having on the world's poorest continent as surging borrowing costs force African governments to cut back on spending, restructure debts, or seek alternative funding. But the question remains, why aren't African countries seeking more funding from their domestic capital markets? Well, today on the show, we'll be speaking to analysts from Nigeria and Kenya on what the African countries must do to develop their capital markets and also what alternative funding sources are available to them. Also on the show today, we'll discuss Nigeria's ambitious plans to raise tax revenues by 57% this year. Well, stay with us. Let's bring you our top business headlines from across the continent. Onto our headlines now. Nigeria made progress towards achieving its 2024 budget oil production target of 1.78 million barrels per day as its December 2023 oil output increased by 7.7%. According to the Organization of Petroleum Exporting Countries, OPEC, monthly oil market report, Nigeria's production rose to 1.4 million barrels per day in December. That's up from 1.3 million barrels per day in November. The country remains the highest oil-producing nation in Africa, while Equatorial Guinea had the lowest output at 55,000 barrels per day. Now, this increase reflects Nigeria's efforts to recover from disruptions caused by oil theft and pipeline vandalism. Stakeholders believe the government's fight against vandalism and other malfeasance in the oil sector is yielding positive results. Minister of State for Petroleum Resources, Heineken Lokpobiri, is confident the 2024 oil production target is achievable, thanks to promising early trends. Now, with oil prices closing at around $7 to $8 per barrel and projected to remain high, experts anticipate increased revenue for Nigeria if production remains stable and meet OPEC quotas. Elsewhere, Finance Minister Wale Edun says that the country is in talks with the World Bank for budgetary support and hoping to receive between $1 to $1.5 billion to address the severe dollar shortage that has contributed to the decline of the naira. The loan will be used to finance development projects and would come with a near zero interest rate. Nigeria had previously issued Eurobonds to raise debt for infrastructure funding and economic growth. The country is also grappling with a budget deficit and persistent dollar shortages, which have put pressure on the naira's value. The Central Bank of Nigeria recently disbursed $2.2 billion to settle outstanding foreign exchange forwards and enhance liquidity in the foreign exchange market. The loan from the World Bank is expected to be disbursed soon to support the country's economic reforms. Meanwhile, the naira reached a record low of 1,320 to the dollar on Wednesday, owing to strong demand. It fell 4.27%, closing at 878 naira 57 kobo to the greenback. That's based on official forex trading data from NAFIN. That's the official market. Elsewhere and outside our shores, Kenya aims to raise 50 billion shillings through public-private partnerships in the next fiscal year, starting in July, to reduce reliance on debt financing for projects. The Treasury disclosed this in its draft budget 2024 policy statement, targeting sectors like power, roads, water, and aviation. Well, Kenya has shifted its PPP funding in recent years to finance projects without increasing debt. The government plans to mobilize 50 billion shillings through a pipeline of 31 projects in the next financial year. The PPP model is crucial owing to limited fiscal space and growing debt obligations. It will facilitate infrastructure development, including water supply, road expansion, and modernizing Jomo Kenyatta International Airport. Kenya amended its Public-Private Partnership Act in 2021 to streamline processes and attract more investors for project collaboration. Those are our top headlines at this time. We'll take a quick break, and when we come back, we'll head straight to the markets. Do stay with us. Nigeria's local equities index, NGX, set a new record, hitting an all-time high of over 90,000 points on the NGX yesterday. We saw, of course, the banks and blue chips leading the rally, taking the index to at 90,063 points. Let's just get right to the numbers now. There it is, the highest number ever on record for the market at over 90,000 points. So that momentum that began at the beginning of the year is actually gathering more snowballing, if you will, as we see from the numbers. That's up 2.38% yesterday for the all-share index. Let's go right to the session's top performers, the best-in-class stocks from the previous session. If we could just get that up. Well, there you have it, the top performance coming from, of course, the consumer goods sector. Guinness taking the top spot, up 10%. Every counter here was up 10% yesterday. Honeywell Flour closing at 4 naira 84 kobo. ICO Insurance up 10%, closing at 1 naira 54 kobo. Wema Bank from the most liquid. And then, of course, investors' favorite at the market, the banking sector, up at 11 naira 66 kobo. Suno Insurance, also from the insurance sector, up at 1 naira 76 kobo. Let's take a look at the top losers for the session. Arte Briscoe down 10% at just 81 kobo per share. Dangote Sugar, also an investor's favorite, and we've seen Dangote Sugar consistently making it to the top gainers list. It's up or down rather this time, 9.9%. NGX Group also on the top losers group this time, down 9.8%. Red Star Express closing down at 4 naira 11 kobo. Sterling NG at 6 naira 90 kobo. Let's go over now to the sectoral performance, just to give you a broad picture of how the sectors performed for the trading day. The banking index up 3.26%. Insurance sector, so that's the financial services stocks, still in positive territory. The insurance sector up 3.63%. Oil and gas, so we're seeing this rising tide lifting all ships, as it were. Oil and gas, consumer goods, industrial goods, all in positive territory. Now, usually when we see the market having this sort of momentum, at some point there could potentially be a correction or profit taking where investors come back into the market, take profit, and we see the index coming down. But it looks like that's not happening anytime soon. But we will be, of course, talking to our market watchers, just trying to get a sense of where this rally is going and what the fundamentals are in terms of what's supporting this rally, how strong these fundamentals are, and if we could see a correction coming to the market anytime soon. But right now, it looks like, from what you can see from the numbers, investors are happy, they're positive, and it also means that they're positive about the economy, which is quite interesting to see when one looks at the economy, what's happening with the economy, especially inflation, and then looking at the numbers. But it's always, positivity is always a good thing. But let's just wrap that up. We'll take a quick break, and I'll be right back to begin our conversations. Join us again. Welcome back. The Nigerian government recently announced an ambitious 18% tax to GDP ratio as it intensifies efforts to boost revenues and support the fiscal budget for 2024. Well, what is the strategy? Martin Arogie, partner ENR Tax Group and head payroll services at KPMG Nigeria, joins us for this discussion. Martins, thank you so much for joining us today.
Thank you very much for having me, Esther.
Well, 18% tax to GDP for tax to GDP ratio, well, that's a little higher than what we have in the region, in the West African region, somewhere between 10 and 15%. Now, obviously, while this will bring in more revenues for the government, what are your thoughts in terms of what the plan is to achieve this, and perhaps also in the shortest possible time?
Thank you very much. Those are very ambitious numbers, because like you already mentioned, we're looking to almost double the current rates. As of today, or as at the end of last year, we're looking at somewhere around 10.8% of GDP. So looking to do 18% in 2024 at the end of 2024 is almost double what we were doing. When you consider the fact that GDP also isn't expected to remain stagnant, it's also expected to grow in 2024. So I think that those are very ambitious numbers. Now, if you look to what government has said, especially the chairman of the Presidential Policy Committee, Fiscal Policy Committee, Fiscal Policy Reform Committee, government is also going to be looking to, first of all, reduce the number of taxes that are currently collectible, try and simplify the tax process, and it does not appear that there are plans to increase rates. So it does look like the focus would primarily be around trying to increase the number of people in the tax net, because that's something that we've consistently spoken about, that the tax net isn't wide enough to cover a significant number of people who earn an income in Nigeria's economy, especially the informal sector. So in order to be able to achieve this, there has to be significant focus on how do we improve collection in the informal sector. One of the issues that has been raised with trying to tackle the informal sector in the past has always been around the cost effectiveness of that process. How much would it cost to be able to implement a tax system that aids government in trying to tax the informal sector compared to how much you would be able to collect from that sector? So the jury is still out as to how we will be able to achieve such an ambitious target by the end of 2024.
Right. Now, I mean, I've had conversations in the past with tax experts who say, well, you want to tax a bunch of people, do you know where they are in the first place? We know that usually technology could help in this instance in terms of widening the tax bracket. Perhaps maybe a national registry, some kind of a central database where you know where you have people and where you can easily identify certain groups, etc. Do we have that? And to what extent are we leaning on technology, that's the authorities now, the tax authorities, to help them achieve this target?
Okay. Now, I used to say the same thing that you just mentioned around, do we have the data? Do we have access to these people in the first place? But I listened to Dr. Yemi Kale speak at an event a few months ago, where he spoke about some of the work they did at MBS and how they were able to, in a sense, delineate a lot of businesses using technology that operate in Nigeria down to their current address, and that information is still available today at MBS. So I don't think that we don't know where they are, or that we lack the ability to determine where these businesses are. I think the question has always been, do we have the capacity to apply the right type of technology that would aid collection at minimal cost? Because if you're going to collect an additional 10 million or 10 trillion, for example, and the cost of doing that ends up being 11 trillion, then it doesn't make any sense. So you need to be able to do it, improve collection at a very cost-effective way. And that's where technology comes in. What sort of technology is available today? And there are quite a number of them. Most businesses already have BVNs and NINs. Most people already have NINs. Most people already have BVNs. So those are very critical start points, and they already exist. It's how do we then mine the information we get from the BVNs and NINs that are currently available to then begin to ensure that we bring a lot more people into the tax net, a lot more businesses into the tax net. So it has to happen with technology. Is the technology available today? No, but the building blocks are available. It's just about having the political will to deploy those building blocks to ensure that we can harness the information that we have today to improve tax collection.
Yes, you make a very good point there. That phrase, political will, that's a key ingredient. But I'd like to talk about the other end of the spectrum now, and that's compliance. I know one of the pillars, or one of the recommendations made by the fiscal committee charged with overhauling the tax system. I remember the head of the committee saying that he's also trying to encourage a better tax culture and compliance on the part of Nigerians. But here's the problem with that. There is a lot of distrust. There's a trust deficit. When you look around in terms of infrastructure development, most people question where their taxes go to. That's not to say that they shouldn't pay the taxes. It's their civil duty. Let's get that straight. But for many Nigerians, that is the thought process. So how do you, as a government, while trying to maybe use the carrot and stick, trying to get people to be more, not to be less averse to paying taxes, how do you get them to pay while you also use other elements, other tools to ensure that they pay taxes that they ought to pay? What are your thoughts?
Okay, I think there are two things. The first one is a general lack of education as to what our tax obligations are. If we don't understand what our tax obligations are, then we obviously would struggle to meet them, even if we are willing to meet them. I had a conversation with someone a few weeks ago who said to me, I'm in paid employment and I pay tax. But while I was going about, I happened to get a contract with a multinational. And then when I issued them an invoice, they told me they were going to withhold tax from that invoice. And the person couldn't understand it because according to them, they were already paying tax monthly from their employment income, and they didn't understand why if they did something outside of employment, they ought to pay another form of tax. And this is someone who is very, very educated. So you can imagine how perverse that lack of tax literacy is, where people don't understand that when you do other things outside of employment income, you still have an obligation to include the income from those other sources when you file your annual tax returns. So you will find that most people only report their employment income, and those who are out of employment typically think that they're outside of the tax net. So that's very important. If we want to improve compliance, we need to also invest in ensuring that we increase the level of tax literacy amongst the populace. The second one, which I think is most important, is I do not think that there is enough deterrence against non-compliance. So it is one thing to be tax illiterate. It is another thing to believe that if I do not comply, there is really nothing that will happen. And because what we see it every now and then, where there is really no punishment for non-compliance. At the end of the day, when you don't comply, what happens? You probably get slapped on the wrist if you are caught. So we need to basically, in a sense, tighten the punitive measures around non-compliance. People need to see that there is some action, there is some punishment that they would face if they are caught in the web of non-compliance. Ignorance is never an excuse. So if we want to drive compliance, we need to begin to show that we are willing to also punish non-compliance when caught. Unless we do these two, invest significantly in improving tax literacy, and then also make the punishment for non-compliance a bit tighter. And I'm refraining from using the word harsher, but maybe that's the word that clearly defines what we need to do. We may not be able to drive voluntary compliance. I don't think there's anybody in the world that enjoys paying tax. Even in developed crimes, you still have instances of tax evasion and tax avoidance every now and then. It's always occurs because everybody wants to, as much as possible, avoid or evade tax. What drives compliance in those places is primarily the threats of what would happen, of the punishment that you would face if you are caught. We don't have that here in Nigeria today.
Right. Let's look at another part of this story, and that is productivity levels in the country overall. We know that a significant number of Nigerians are living under the poverty line. You know, we hear the word multidimensional poverty being mentioned often. So the question is, okay, you want to, as a government, increase the tax bracket, but how much does the average Nigerian make? I'm not talking about those, the white collars, where, you know, there's a database and, you know, the payee system, etc. I'm just speaking generally now, productivity levels versus vis-a-vis the population of the country and the kind of amount of money that the country can even raise. Could that potentially be an issue too?
Yes, clearly. So when we talk about GDP, for example, GDP per capita is also a very, very important attribute to consider, because if that GDP is spread across a large population and each person, in a sense, its own contribution to that GDP is extremely minimal, then there's very little you can get from them. They may even fall fall within what we call the tax exemption brackets. Because until you earn above a certain minimum threshold, you are exempted from paying tax. So if the bulk of the population are below that threshold, GDP may be great because you have a large number, and that small per capita income is spread across a very large number. But it limits your ability to raise tax revenues because, hey, these people do not earn enough to be able to contribute in terms of tax revenues. So yes, that's a very important factor that we will need to consider.
All right, final question. I know you said that, I guess general consensus is that the figure for this year is ambitious. But let me just ask you and put you on the spot directly. Do you think that we can achieve this number?
Over the course of a year, no, I doubt it. I think it's a long-term, a more mid to long-term target, not necessarily a one-year target. You would need to invest significantly in technology, tax literacy, and also some changes in the tax law that makes it, again, that increases the punishment for non-compliance. All of these things will not show result or show its effect or its impact over a 9 to 12 months period. I will think that we can begin to look at this over probably a 24 to 36 months period. So I'm not particularly confident that we will do this over a 12-month period.
Right. Perhaps in fairness to the authorities, set the bar high and then, try to achieve it. And if you don't, why not to make another attempt? Thank you so much, Martins, for talking to us today. We appreciate your time on the show. That was Martins Awoniyi, partner, ENR Tax Group and Head Payroll Services at KPMG Nigeria. We'll take a short break, and when we come back, we'll continue with our conversations. Join us again. Welcome back. Before we start our next conversation, a quick look at international headlines. Workers in Europe are hoping this year's pay round will help restore incomes eroded by higher prices. However, the expected boost to their purchasing power could hamper the European Central Bank's efforts to bring inflation back to target. The ECB has singled out wages as a single biggest risk to its one and a half year crusade against inflation. It expects salary growth across the Eurozone of 4.6% this year. That's far more than the 3% pace it considers consistent with inflation at its 2% target. A higher wage settlement would be a risk to interest rate cuts that financial markets are betting will start in April. Elsewhere, most Asian equity benchmarks fell, led by China, after strong U.S. retail sales data cast fresh doubt on the likelihood of a Federal Reserve rate cut in March. An intensifying drought has made China the world's worst-performing major stock market in a new year, as authorities struggle to reverse a deepening housing slump and stubborn deflationary pressures. The Shanghai Composite Index slipped below 2,800, the lowest since 2020, as authorities signaled they will avoid huge stimulus to revive growth. Japan's shares slipped as the yen halted a three-day loss, and concerns grew that the stocks may overheat after recording a strong start to the year. U.S. stock futures edged lower. The muted outlook for China and the repricing of expected Fed cuts have erased 2% from the global stock market this year. And at the commodities market, oil gained as twin incidents in the Middle East underlined the region's rapidly escalating tensions, which have already snarled global shipping and carry the potential for interruptions to crude production. Brent crude rose above $78 a barrel, while the West Texas Intermediate crude topped $73 a barrel. In Yemen, the U.S. struck more than a dozen Houthi missile launches in its latest response to the Tehran-backed group's repeated attacks on shipping. Widely watched time spreads suggest conditions are tightening. The Brent's three-month spread widened to almost $1 a barrel in backwardation, a bullish pattern in which prompt prices command a premium to those further out. That compares with 33 cents in contango, the opposite structure, a month ago. A quick break, and when we come back, we'll head straight to our conversation. Join us again. Welcome back. Cote d'Ivoire says it will head to the international debt markets as early as next week to issue a Eurobond ending a 2-year drought for African bond issuances at the international debt market. Meanwhile, debt levels continue to rise across the African continent as governments struggle with debt service payments and shrinking fiscal budgets, where analysts say underdeveloped capital markets on the continent also contributing to the problem. Well, we have an analyst from Chapel Hill Denham, James. He joins us to discuss this problem as it continues to unfold. James, thank you for taking the time out to join us today.
Thank you very much for having me, Esther.
I'd like to just get your thoughts on the international debt market this year. The last we saw was in 2022. And the reason we're seeing that rising cost of borrowing is because we've seen that rise in the U.S. Interest rate, the Fed, of course, increasing rates. Now, the last time we saw an African country go to the Eurobond market was in 2022. Kenya made an attempt in 2023, but quickly canceled those plans. Now we're hearing that Cote d'Ivoire could be heading to the market as early as next week. But the big question, what I want us to discuss today is domestic capital markets and how they could support African governments in funding their fiscal budgets. But I'd like to just hear your thoughts on the Eurobond market and why we're seeing this disproportionate impact of rising U.S. interest rates on African issuers.
Yeah, so to start with, post-COVID, we noticed that a lot of emerging markets, countries in Africa, were affected by the pandemic. And what that meant was, because they rely heavily on commodities and there was a shortfall in the revenue from commodities, these countries had to, look for other, or be innovative in ways to raise capital, right? And, the Eurobond market at that point in time wasn't so favorable. They didn't have revenue. They needed to get some cash to be able to fund their budgets. So what we've seen is that because these most developing countries need to fund their infrastructure growth, they've come back to the markets, given that the forward guidance of the Fed seems to indicate that yields of interest rates in the international market could possibly taper down in the second half of this year. And so this seems to be a time when we will begin to see emerging markets come to the market to raise Eurobonds. They've suffered the shortfall, and at this point in time, they really need the cash to continue to, grow their economy, to continue to fund their infrastructure deficits, in order to run their budgets.
Now, we may be, well, that's what has been put out to the markets, that there could be a potential Fed rate cut too this year. What could that mean for African issuers? Could we see a significant drop in borrowing costs, or will rates continue to hover at current levels?
At current levels, we've already beginning to see that interest rates in the Eurobond market have dropped. Using Nigeria as an example, we've seen that most of our Eurobonds are trading in single-digit interest rates, and so with the expectation that there will be possible we begin to see interest rate cuts in H2 2024. It would also mean that we would possibly begin to see the interest rates in the Eurobond markets decline. And that would mean that we would see more capital flow back into emerging markets like Nigeria and other African countries.
Now let's look at the domestic capital markets on the African continent. One avenue that perhaps countries could lean on perhaps more to fund their annual fiscal budgets, perhaps with the exception of Egypt, South Africa, and Nigeria. If you look across Sub-Saharan Africa, all other markets appear to be not deep enough and underdeveloped. Nigeria has made some progress in that area. I believe at least 70% of government revenues, or rather funding needs, taken from the domestic market, and the other part of it, foreign loans. But what should African governments begin to do perhaps as a first step? And why has this problem persisted for so long in terms of how these markets are developed?
So while we might take Nigeria as an exception, I think it's important that we learn from how our domestic market has evolved over time. And using that, we'll be able to guide other African countries to deepen their capital markets. The AUMs for pension funds has grown over time, and this is as a result of the restructuring of the pension industry, our support from the government, and these are things that we should see other African countries begin to do, because by doing them, it would mean that the government would be able to rely on the domestic market a lot more. Now, because these pension funds have regulatory guidelines on how to invest their capital, and most of it has to be in risk-free instruments, which would mean, government instruments, right? Then it would mean that they have to be very particular about the pension industry in their countries. They need to ensure that this industry is stable and it is continually growing. That would be a good way to begin to make the capital market, the domestic capital markets in these countries deeper.
Now, we've heard the likes of the World Bank, the IMF, even Fitch, some of the ratings agency point to the fact that rising debt levels on the African continent will be a key risk for sovereigns in 2024. What is your research telling you in terms of the scale that we could see in the course of the year? We've seen the likes of Ghana already restructuring their loans. Fortunately for Ghana, they were able to secure a $3 billion loan from the IMF. We've seen Zambia, but there've been talks about whether Nigeria needs to perhaps also take that step. But if we could just hold that thought for us, we did get some comments from Nigeria's head of Nigeria's budget office, Ben Akabueze. Recently, one of our correspondents did pose that question to him, and he was a little cautious in his response. But let's just take a look at, listen to what he had to say, and then we'll come back and continue our conversation.
Once you talk about debt restructuring, lenders just don't like. It's a word that they don't like to hear. So we look for opportunities to refinance existing portfolio into cheaper options, but there's currently no plan to start engaging with our lenders, to talk about them, restructuring, the debt. There's no such plan for the moment.
Do you think this is the time for us to have that conversation?
Not quite. We have managed. As you heard, even in terms of when you look at all parameters of debt sustainability, we look good except when you get to debt service to revenue ratio. But what you see, as you heard today, even in that, the trend is positive. Debt service to revenue ratio is trending downward because our revenues are growing. If we survived at the time when that was, we talked about when we're spending up to 96%, there's no necessity at this point in time to start having a debt restructuring.
Well, that was Director General of Nigeria's Budget Office, Ben Akabueze, stressing once again that Nigeria has no plans to restructure its debt. Well, he goes further to even say that lenders, creditors do not like to hear that word restructuring, and that Nigeria will be looking for cheaper options to fund its debt or meet its infrastructure needs. Let's get back to James, our analyst from Chapel Hill, Denham. James, just listening to the DG of the Budget Office saying that, look, creditors, lenders do not like to hear that word restructuring. But what do you make of it when you look at Nigeria's debt stock, when you look at how much the percentage of revenues being spent, being spent on debt service, and Nigeria approaching the World Bank for a loan, Nigeria having to meet with creditors? We know that meeting happened not too long ago, talking about what the plan is in terms of how Nigeria is going to, pay back these loans. What do you make of all of this? How do we strike that balance between not scaring off or making our creditors nervous about whether or not we can pay back, and also realizing that we do have a huge debt load on our hands, and we need to begin to have some serious conversations?
Okay, so first of all, I tend to agree with him in the sense that if you look at our debt burden, if you look at our debt to GDP ratio, it's well within the threshold that is recommended by the World Bank, right? But if you look at our debt service to revenue ratio, that's when you see that there's a problem. And what that means is that, if you're using a lot of the funds that come into government coffers to settle debt service, then you don't have enough money to invest in infrastructure and to build your society or your economy. So, the debt service to revenue ratio is really a problem. But I don't think we're at the point where we need to begin to scale off lenders, as you said, the word debt restructuring, right? We're approaching new lenders, and it's largely because of our FX problems. We also need to attract, or we need capital, FX to be specific, to stabilize our currency. But looking at our debt profile, our Euro bonds, our FX obligations are spaced out. I think the next maturity is November in 2025, and we have staggered obligations from there. And so that means that with a well-spaced out debt profile and with our increased revenue to be able to take on the debt service that we are expected to pay, it will mean that moving forward, the outlook looks positive. The new administration has made some reforms which are positive, and if they are implemented transparently, if they are implemented effectively, my view is that they will translate to extra revenue for the government, and it will mean that the debt service to revenue ratio over time will begin to decline.
Can we take a cue from where yields are right now at the bond market, as a domestic bond market here in Nigeria, the treasury bills market, perhaps the 1 year, the 2 year paper, and I know that the 2050 paper has not too long ago been popular, perhaps still is, with investors on the yield curve. But talk to us where interest rates are right now, where the bond treasury bills rates are right now from what the government raises at the market vis-a-vis its debt service. Is that going to be, are we seeing rates high? Are we seeing those yields high to the extent that they could become a problem for debt service for the government?
Okay, so interest rates at the short end of the curve are typically what I would like to describe as a double-edged sword. And I say that because we need to jack up interest rates at the short end of the curve. We're trying to attract foreign investors through the open market, which allows banks and foreign investors to invest. But at the same time, it also brings in the question of how much can they take on their balance sheet, right? If you are borrowing at really high interest rates, then it would mean that your debt service is going to increase. But then again, we also have the fact that the government is really doing a lot on the tax front, and that will bring in extra revenues. So the net impact of all this, seems to sort of even out, and it would mean that despite the fact that we are going to be borrowing at elevated levels at the short end of the curve, double digits, it also means that if they are able to see other sources of revenue pull through, then we'll be able to see capital that would service the debt. But looking at the debt service to revenue ratio, looking at the short end of the curve, I think it's just necessary that we attract FX at this point in time, jack up interest rates at the short end of the curve to attract FX to ensure that our currency is stable, and so that there's price stability. Inflation is reined in, and at that point in time, we then begin to look at how we can cut expenditure, and that will be able to help us to pay the debt services, to service our debts properly. With the capital that's coming in, the inflows that are coming in. Let's also not forget that because it's domestic market, it's within the it's being serviced in naira, not dollars. So don't begin to question, how the ability of the government to pull in FX into the market. We begin to look at things like tax revenue. How much are they able to leverage on stuff like that, non-oil revenue, to be able to service their naira debt. So that would be the local or the domestic leg of our total debt.
Now, back to that broader debt conversation. Another part of this conversation is the value that African governments, including Nigeria, get for the loans that it take in the first place? Obviously, if you're going to take loans, it should be spent on production. If you're taking loans to fund infrastructure projects, maybe roads, many of those roads have to be tolled. If you're building trains, railways, of course, ticketing, plowing back into getting those loans paid. Some of the analysts that I've spoken to have said that perhaps that is one of the problems why many African countries cannot even repay the debt, because a lot of the debt has gone into the consumption hole and cannot fund that debt service in return. What are your thoughts on that?
I think it's true, right? That you bring in capital to the market, into the country. It's expected that you channel the capital into things that will generate revenue, things that will generate value, as opposed to consumption pools, as you said. I think that it's necessary for the government to, begin to place a stronger emphasis on, being able to generate revenue from assets. A lot of the assets that the government runs, some of them, not a lot of them, some of them, they're really just lying there dormant. They're not doing much, right? And if we're not able to leverage these assets, then how are we going to generate the revenue to pay back for these loans? And that becomes a question that the government has to take seriously about. They need to be able to put in place structures that ensure that when they invest in or when they bring in capital, this capital is invested in infrastructure and they are able to recoup, their revenues adequately, effectively from this investment, and they are able to pay their debt. If these infrastructure projects are not bankable, then it's not intuitive to invest in them, right? It's better to look for other forms of capital or other ways to raise capital rather than to go to get debt just to service the consumption market. It doesn't help us in any way.
You make a very good point there, James. Bankable, that's the word. The projects have to be bankable, but we're going to have to leave the conversation there. Thank you so much for talking to us, James. We appreciate your time on the show today. James Oladisa, analyst on Chapel Hill Denham, taking us through a conversation on rising debt levels across the African continent. But that's our show for today. Many thanks for being a part of it. Remember, we are on social media. We are at News Central TV. Head to our website, newscentral.africa. You can also download our mobile app on Play Store and App Store. Till next time, I'm Esther Awoniyi. Bye for now.